Welcome. I'm Chris Tilley, the director of the UCLA Institute for Research on Labor and Employment. Very happy to be welcoming Eileen Appelbaum and Rose Batt. And for an event co-sponsored with the Anderson Organizations Group, thanks to Corinne Bendersky, who's holding court for the Organizations Group as well. And let me say a little about Eileen and Rose, and then let them talk about private equity. Eileen Appelbaum is senior economist at the Center for Economic and Policy Research in Washington, D.C., and at the same time visiting professor in the School of Management at the University of Leicester in the United Kingdom. Some of her recent books include Unfinished Business, Paid Family Leave in California and the Future of U.S. Work-Family Policy, Low-Wage America, and Manufacturing Advantage, Why Higher Performance Work Systems Pay Off. Rosemary Batt is the Alice Hansen Cook Professor of Women and Work at the Industrial and Labor Relations School at Cornell. She's coordinated the Global Call Center Research Project, which was quite an amazing research project. Also co-edited the Oxford Handbook on Working Organization. Currently co-editing the Industrial and Labor Relations Review, and has widely published in labor relations. They actually co-authored a previous book, The New American Workplace, Transforming Work Systems in the United States. That's going back, what, 20 years? Or?
We publish a book every 20 years.
I'm certainly looking forward to the next one. And I just want to take personal privilege and say these are both old friends. Rose was a classmate in graduate school. Eileen read my manuscript when I sent it to Temple University Press of my first book, and gave me very helpful guidance, I must say. So people that I've known and have worked with for years, this is a really interesting new direction, the work on private equity. They're talking about their book, Private Equity at Work, When Wall Street Manages Main Street. So let's give them a warm welcome.
Thanks, Chris. It's great to be here, and it really is great to be here. I was here, I think, about 10 years ago. I was doing the global call center stuff, I think, in the presentation. Anyway, our book came out early, so I'm just hacking it a little bit. But I'll just send it around. This is to let you know it's a serious book, rather than just some kind of. Anyway, I'll just pass that around. And I want to know, is this the? Yeah, that's that little green thing. So I'm going to get right into the material because we have a lot to cover, and we want to leave time for questions and discussion. You should feel free to interrupt me with questions. I'll try to keep things moving, but I also want to have this be a little bit interactive so that we're not just waiting till the end to get into some of the more meaty stuff. So let me start by saying this is our 5 questions we'll go over. So why focus on private equity? What's the private equity business model? How are private equity owned and public corporations different? What are the outcomes for various stakeholders, and what policy recommendations do we have? Okay? And to get this motivated, I'll start with a couple of stories. And why private equity? Part of it is that it's been a very controversial financial model. There are proponents who say it does really good things. There are critics who say that it's it's vulture capitalism. And so there are these widely different claims, and we wanted to kind of make sense of them. And so here are 2 stories to illustrate that. Both of these companies, Aidells Sausage and Mervyns Department Store, California, iconic companies. Are people familiar with the names? Mm-hmm. Yeah. Okay, good. So Aidells was started by a microbiologist and foodie named Bruce Aidells in the 80s. He created a chicken sausage that was apparently delicious. It was in the Bay Area, became wildly popular, and then saturated the local market. And in about 2007, he sold the company to Encore Capital, which is a private equity firm. And The private equity firm provided funds for technological development and marketing to take Aidells to a kind of national level. So it prepared it for the next kind of jump in its growth. It was bought out. It was, by the way, private equity, or Encore bought it for $34 million and 40% debt in 2007. 3 years later, sold it for $87 million, more than twice. And the number of employees increased from 140 to 350. Sold it to Sarah Lee, which was interested in developing its specialty needs. And it's a big success. It took a small company, got to scale. Then we have Mervyns department store, which was bought out in 2004 by Sun Capital and a consortium of private equity firms. They put down only a third of the equity, $400 million, and took out 2/3 in debt, so $800 million in debt for a total of $1.2 billion. They immediately took out another $400 million in loans, loaded that on the company in addition to the original debt, in order to pay themselves dividends. Then they divided the company into two, an operating company and a property company, which is a typical strategy in private equity. They sold the property company and then made the stores lease back the property at inflated rates. And by 2008, the company went bankrupt. And in that year, they had $64 million in losses, but were paying $80 million in rent. So if they had, retail tends to hold on to property because in the downtime, they don't need to have the revenues, and then they can survive those downtimes, but they couldn't in this case. 30,000 employees lost their job. So, good, bad. Look at the scale, of course, of these two stories, and now I'm going to drive you through a little bit of other information on private equity, and then Eileen will pick up this story a little bit later. Okay, so another reason to understand private equity is that in our field, management, organizations, employment relations, Eileen and I felt that we have not done a good enough job in understanding how finance and capital markets and ownership structures influence the behavior of firms. So we know a lot about, for example, globalization and changing product markets and how that influences firm strategy. We know a lot about labor market institutions like unions and training and education, but we've not focused on the capital side. So we wanted to do that, and we picked private equity because it's the most invasive form of financial intermediary, in that it not only buys a company and takes it private, but then kind of dips its hand into the management of the firm. So we wanted to look at that. And it represents a kind of extreme form of the shareholder value model. So as we see the shareholder model moving into increasingly public corporations as a whole, this provides a model of a much more extreme form. What does that look like as an advanced form? Private equity is large and powerful, so about 2,800 firms in the US, about 18,000 companies, which represent about 5% of the total, and about 7.5 million workers have been in companies owned by private equity over the last decade. 7.5 million is about the level of workers in unions today, so to give you a sense of that. And we wanted to offer then some policy proposals. So I want to walk you through, there are two main points I want to mention from this graph. The first is, as you see, the blue is capital invested in private equity, and the yellow is the number of deals each year. And so there are 2 points. Obviously, there was a big run-up, accelerated pace of development of private equity in the 2000s. Crash hit. But what's important is that by 2012, there were more deals and more capital invested than in 2005. Well, more capital, I'm sorry. And the growth is kind of continuing. So this is a form of financing that's here to stay. We need to take it seriously. It's a minor player, but it's an important player in the economy. And so that's why we think it's important to look at. Okay, now I'm going to spend most of my time on this kind of complicated model. This is the structure of private equity at the level of the firm, the fund, and the portfolio company. So it's a multi-level structure of the firm. I'm going to walk you through how the model works. We start here. The general partners are the partners of a limited liability firm, and they make the decisions. They put in about 1 or 2% of their own money into an investment fund here. The rest of the money, 98%, comes from the limited partners, who are wealthy individuals, pension funds, etc. Importantly, 35% of private equity funds come from pension funds. So this is one way that private equity affects many, many people that not only as workers down here at the portfolio, but also in terms of their retirement savings. Then we move to the fund buys a company, portfolio company, putting down typically 30% of the equity investment, and gets 70% from the creditors, from banks, etc., that load the debt onto the portfolio company. So it's not the limited partners or the general partners who take on the debt, it's the company. Then in terms of profits, if we go back up, after a hurdle rate of about 8%, the partners earn 20% of the profits. So 2% of 30% is about 0.6 that they invest, but they get 20% of the profits. In addition, they get fees from the limited partners of 2% annually. Now, if you have a fund of $100 million, and what I didn't mention is the limited partners must keep their money in for 10 years. They must keep that available. At 2% a year, they're paying $2 million a year times 10 years, $20 million off the top, regardless of how the the firm performs. So private equity gets 20% of the profits, guaranteed 20% of the, like 20 million of the 100 million, plus advisory and management fees from the portfolio company because they're consultants, they pay themselves for consulting advice, for advising, etc. And this can also run in the millions. So, in fact, a number of private equity firms make more from the fees than they do from the profits. So, this is a very lucrative arrangement. Note that the general partners make all the decisions, where to invest, what strategies at the firm level, and the limited partners have no say. Okay, so it's a very asymmetric relationship. Now I want to make one other point on this slide, which is now let's move back to this general level. You see there are two companies here, but there are more that extend out. And then there's another fund here, and we have a whole slew of companies. So, for example, Blackstone invests in 170 companies right now. Apollo, 250. So, what is this structure? This is really the old diversified conglomerate model that has been maligned. However, each of these companies is legally separate. So, if one company goes down, I had high risk here, but it didn't pay off. So I'm playing a numbers game. So I can have a number of these companies go down. Now for these people, it matters here, right? Because they have only one company they care about. But the private equity model is set up so that it minimizes the risks for the firm partners by spreading the risk over so many companies and by not having so much investment on the part of the general partners. So it is, we argue, an incentive structure that provides low risk, high returns. And that is the theme of our first, I'm going to give you now 4 themes in our book, is that the private equity model itself builds into the structure moral hazard. And that's an economist term, you probably mostly are familiar with it, which means that the owners have the primary decision-making responsibility. They make the decisions. They put very little of their own money at risk, and they do not suffer the consequences because if something goes under, as I said, they don't hold the debt, the company does. So it's a classic example of moral hazard. We use other people's money, take a disproportionate share, externalize risks to stakeholders, embed the incentives for high risk in the model, and it provides a low risk, high return strategy for the partners themselves. Okay? Okay. So I'm going to now talk about 3 other themes that are central to the book. The first is that we develop an idea that these investors are really managers. So the law treats private equity as an investor class. They're financial intermediaries. They invest. However, they act as managers and employers of the employees in the companies that they buy. So how does that work? Well, at the pre-buyout stage, they set up a capital structure and management plan. And that capital structure typically has a high level of debt, right? It's the classic leveraged buyout form. So if I have 70% debt loaded on the company, I need to figure out what is my strategy for servicing that debt and exiting the company in a relatively short period of time and making money. And so the debt structure drives the management plan. So the private equity is not going to buy this company unless it figures out how that debt structure can be serviced. And so the management plan is derivative of that capital structure. And so what we argue is it essentially turns Chandler on its head. If you're familiar with Chandler, it's not that strategy drives structure, it's that the capital structure drives the strategic plan. And then in the post-buyout, the debt structure drives the plan. Well, how does that happen? The private equity sets the strategic direction, including which units to shut down or sell. So I'm going to look at the assets and maybe get rid of some of the underperforming ones or the ones I don't think are core. I'm going to sit on the board of directors to monitor the execution of the plan. I'm going to manage and hire and fire. Typically, the CEO receives a compensation of pay for performance that is tied to the exiting when they sell the company. But if the CEO does not go along with the plan, they're fired. So some of the econometric studies have shown that about 39% of managers in private equity-owned firms, executives, are fired in the first 100 days. Because that's when they set out the plan, and if you either kind of buy into it or you don't. Then in addition, they seek to repay the debt or service the debt through cash flow, cost-cutting, tax advantages, amend and extend agreements. Eileen will talk about, but it's a way of essentially rolling over your debt and getting an extension by requiring the creditors to readjust their their investments. The dividend capitalizations, that's the Mervyns story, in which essentially I take out a dividend, I take out a loan, and then I use it to pay myself back a dividend, etc. So there are a lot of financial strategies. Eileen's going to go into them in more detail, and then after 5 years I try to sell the company. But the point here is that the investors are, for all essential purposes, the strategic managers and employers in the company. Debt, my second point, is the lifeblood of private equity, because as you see, it's this debt structure that is driving the decisions, but it's also the way, not only that I buy companies, but I get higher returns, because there are tax advantages to using more debt than equity, and there are multiples from using debt. So then the last point I want to make has to do with figuring out the private equity model and how it's different from the public model. And some people have said to us, well, it's just kind of a more extreme version of shareholder value. It's not that different. And so we've kind of had discussions about this and gone back and forth. And we're coming down on the side that at this point in time, it is different. But that there are spillover effects, right? The public corporations can learn from innovations from other firms, and then this may be adopted more generally. But for right now, the capital structure is fundamentally different, with probably about 70% to 30% equity here, but in your public corporations, the opposite. Regulatory oversight and transparency and accountability are all quite low. And that's for two reasons. The portfolio company, once it's bought, is taken private, so it is no longer required to file with the SEC. So we have no information at all about what is going on, how many employees, what the finances are, etc. But then at the level of the firm, the new Dodd-Frank law requires private equity firms to report, but very, very minimally. So they, for example, can write a verbal narrative of what their firm is, whereas the public corporation has a very, very detailed set of reporting requirements. So this is quite low. Risk-taking, as I've talked about, is quite high because of that moral hazard story, whereas it's much lower here. The use of junk bonds, that is, these taking out debt at very high interest rates, is quite frequent here. It's actually, in the last year, gone up again. It had come down in the crisis, and now it's picked up again. Low here. Asset sales, the proceeds here go to the private equity owners, whereas here, the proceeds go to the company and may be reinvested. Dividend capitalizations, frequent, rare. Fees, a key part of earnings, but an executive cannot charge advisory fees to its business units. And then finally, the reputational effects are different. The story here is that if a company goes bankrupt, few people know who owns it. So Friendly's is an example of a company that went bankrupt. Did anyone know it was owned by private equity, and in fact it was the private equity debt that drove it into bankruptcy? No. We attribute the fault to Friendly's. And so we say, oh, maybe they were mismanaged, etc., as opposed to, if it's a public corporation, we blame the corporation itself. So here's another kind of veil or place where transparency is not strong. So with that, I'm going to turn it over to Eileen.
Okay, so how does private equity make money? And I'll begin by making a distinction between profit-seeking and rent-seeking strategies, which may be familiar to some of you. But in a profit-seeking strategy, what the management is trying to do is they are trying to grow the company, increase market share or increase productivity. They're contributing to a larger economic pie. And as the pie gets larger, the slice that goes to shareholders gets larger because the pie is larger. But the slices that go to creditors, to vendors, to workers, to managers also get larger. Rent-seeking activity is where the owners, the shareholders, try to increase their slice of the pie without first increasing the pie. So they're going to increase their slice of the pie at the expense of everyone else, of all the other shareholders. And we'll come through with a couple of examples when I get to the next slide of how they do it. It's not just workers that are disadvantaged in that situation. It's all of the other stakeholders and taxpayers as well. So that's the first thing, profit-seeking versus rent-seeking activities. And on the profit-seeking side, we do have examples of private equity coming into companies and actually developing business and operating strategies, as you heard with Aidells sausages, that move the company to the next level, or in some other way improve the operation of the company or improve its business strategy and lead to positive outcomes for everyone. So one of the important ways they do this is to look for a company that is undervalued in an industry where they anticipate there's going to be high growth. And my example of this, and I certainly hope it works out for the private equity company and everyone else involved, is that private equity bought the Detroit Medical Center at a time when I don't think, given the situation in Detroit, anybody else was going to invest. There are no public monies to invest because Detroit is bankrupt, and there are no for-profit companies that want to come in and take over Detroit Medical. It would be very difficult for a for-profit company to do that. Private equity came in anticipating that with Obamacare, charity care would go down and the hospital could be made profitable and they would be able to benefit from it. When you take a not-for-profit hospital and you turn it into a for-profit hospital, you have to deal with the Attorney General of the state because obviously that hospital has had a lot of advantages. And in Detroit, private equity is investing in the facilities, is investing in the IT, is really improving. It agreed to continue for 10 years to provide charity care, not to take away the social safety net aspects of the hospital. Them well, I hope that it works the way they want it and that they make money and that Detroit has a really first-rate medical center as a result. Another possibility is to come in and make operational improvements, and we have an example of this. Axle Tech makes vehicles mainly for military, heavy-duty vehicles, not car-type things. Private equity came in. They had been a successful but small company. They didn't really know how to improve their operations, what they needed to do in order to grow, and private equity came in and provided that kind of management insight, and they also were quite successful. The Aidells sausages you've already heard of. Awarex is a tiny little company, a very bright entrepreneur who noticed that when you go to a hospital, you'll often find that the emergency room is overcrowded, and it's overcrowded because someone has come in with some problem that needs to be admitted to a particular department of the hospital, but there's no clean bed in that department. The housekeeping staff was fixing up other rooms that may not have been as necessary because there's no communication, or you need a wheelchair and you don't know where it is, or the gurney is someplace, but somebody has to go find it. Awarex came up with a system for keeping track of all of this and knowing what the priorities were so that you could keep the emergency room from becoming unnecessarily overcrowded. Had no idea how to turn this in. They had one hospital doing it. Private equity came in, soon had 15 hospitals doing it, and it's quite a successful system. And then what we all hear about, what everybody likes to talk about who's part of the private equity industry is distressed and turnaround investing. Well, of course, we come into companies that are in big trouble, and we do our best to turn them around. And sometimes we're successful, and isn't that wonderful? And of course, they were in trouble before we got there, so sometimes we can turn them around, and people lose their jobs. We did our best. That's the public story. Well, up until the Great Recession, private equity investing in distressed investments was about 2% of total investment by the private equity industry. So yes, there are specialized companies that engaged in this kind of activity, but it's quite small. It did get a little bit bigger after the Great Recession. We had many more distressed companies, and so it did get a little bit bigger, but it's never been most of what they do.
Can I ask you a quick question?
Sure.
Do you think the motivation behind Is that profit seeking or rent seeking? No,
This is profit seeking
This is
in
all
my view.
profit seeking.
These are all situations in which the private equity comes in and is trying to make money by making things better in some way, investing,
For the
providing
long-
leadership,
for the long
management
term.
know-how.
I mean, relatively long.
They may
No, it's
take
not
the-
long-term, they're out in 5 years. The goal is to be out in 5 years. So compared to hedge funds, as they like to say, oh, we are long-term investors. We don't do, high-frequency trading, but their goal is to be out in 3 to 5 years. In the Great Recession, they couldn't always make it, you couldn't necessarily find a buyer. But now what you see is that, take the company public, if you were in the middle of the Great Recession and the market was down. But what you see this past year is that they're very, very busy doing IPOs as much as they can because the market is up. They think they'll be able to get their money out. But these are all, in our view, they certainly put debt on the company. They certainly use financial engineering. I'm not saying that these are not the guys in the white hats or anything like that. But their main approach is to try to grow the company or improve its management, situate it to be a strategic acquisition of a major corporation and so on.
But they do take a disproportionate share of the profits.
Yes, they still
Like
do.
a much higher proportion.
Yes.
Yeah.
Yeah, that's still, you heard the Aidells sausages. They made a lot of money for themselves, and they used debt to boost their returns as well, but just not as much. In a minute, we'll get to why, some of the reasons that's not quite as much. Okay, and then the other possibility, and this is more the rent-seeking activities, is financial engineering, where basically the share going to the private equity owners is coming out of other people's part of the pie. They take over resources from portfolio companies, and Rose already mentioned that you have a company, it comes in, puts an equity down payment, and in the first year or two, we'll have the company that it bought issue junk bonds, which the acquired company has to repay in order to pay themselves back and have no skin in the game at all by the end of a year or two. This is completely apart from all the management fees that they've also been collecting. So they quickly pay themselves back, and in many cases, this will drive a company into bankruptcy. Harry and David is an example where they paid themselves back in 1 year, and it's been, it entered bankruptcy as a result. We have a lot of examples of that. So selling junk bonds to pay yourself a dividend is what's called a dividend recapitalization. The other thing, which Rose also mentioned with respect to Mervyns, is the OpCo-PropCo model, where they buy companies, and this would be in retail, this would be in nursing homes, this would be in a chain of golf courses, this would be in a restaurant chain, a company with lots of real estate. And then they divide the company into an operating company, which has to operate the business, and a property company, which now owns all the real estate. And after they hold it long enough to get the tax advantages of holding it, they sell it to a real estate investment trust. And sale-leaseback agreements are not necessarily bad, as Rose was saying. If you sell the company, you sell the assets, and you get the money, and you use it to invest, or whatever your purpose as a company was, it might make sense. It's sense to do a sale-leaseback. So you sell the property, and then you lease it back, but you keep the proceeds of the sale. In this situation, the proceeds of the sale go straight to the private equity firm and not to the company whose property it was. So that's the OpCo-PropCo model. And if it's a cyclical industry, you can see that it puts the company at risk. We have a tremendous number of bankruptcies of companies that were engaged in this OpCo-PropCo, and then the recession hit. They hope to get out in 3 to 5 years. All they need is no recession in 3 to 5 years, and they'll be fine. The trouble will come after they're out of the company. With respect to workers, one of the things they do is they come in and before they take over the company, they take a look at the wage structure, the number of employees, compensation, and so on. And especially with respect to the wage structure, if they take over a unionized company, what they say is, well, compensation is out of line. I mean, the whole purpose of unions, of course, is to get better wages and benefits for their workers. You have somebody representing you collectively, and you are likely to have a better pay package. But when private equity comes in, they say, well, this is out of line, and so we're going to have to get it back into line, meaning people are going to have agree, the workers will have to agree to the concessions in advance. They also will make decisions as to which facilities to sell off or to shut down, and that can lead to the loss of jobs. And of course, if they drive the company into bankruptcy, as they did with Mervyns, 30,000 workers lost their jobs in that one. But even if that's not the case, when they take a publicly traded company private, you have substantial declines in employment relative to companies that were not taken private, and retail is another one. From taxpayers, that high level of debt, the publicly traded companies are 30% debt, 70% equity, because small shareholders are risk averse. Nobody wants to own stock in a company that is 70% debt.
Right.
But private equity can do that. So debt, the interest on debt is tax deductible. It comes off of your income, whereas the dividends on equity are taxable to the corporation. So by having 70% debt, you reduce what you are paying in taxes immediately. And they engage in tax arbitrage. So they're big. Private equity companies are big. So they hire people away from the IRS who know every little loophole that there could be, and they turn their the accountants who pay the taxes for them are not just sitting there filling out forms. They operate those as a profit center. And many times the companies they acquire are now newly headquartered in a file cabinet drawer in the Cayman Islands. So a lot of tax arbitrage going on. And then with creditors. So people have come along and lent them the money for this 70%. Initially it will be a bank, and then the bank will securitize that, and you get collateralized loan obligations or collateralized commercial mortgage-backed securities. And now it's owned by lots of different people. And people have these bonds. Okay. So this would be Apollo, which bought Harrah's Entertainment, if you're familiar with it, now Caesars Entertainment. Well, they bought the company with tons of debt, and in not too long a period, they bought it right before the recession. So it wasn't, nobody was going to Las Vegas in the middle of the Great Recession or to Atlantic City to go gamble, way off. So they're not going to be able to make those payments that they're supposed to make on the loans. And so they say to their creditors, well, you could insist on our making the payment. We won't be able to do it. We will go into bankruptcy protection, and you'll get what the courts decide that you'll get, and who knows what that's going to be. Or, we're happy to buy back the debt at 50 cents on the dollar. And that's what they did. That's what Apollo did. And what they do is they then say, okay, we'll buy back the debt at 50 cents on the dollar, and the remaining debt, you will extend the deadline for when we have to pay it back, and we will pay you a higher rate of interest on the remaining debt. So those were called the amend and extend agreements. They would amend the agreement, they would buy back part of, well, the part that they bought back is a debt exchange. And then they would have, for the rest of it, they would have an amend and extend. So you'll extend the life of it, and we'll amend it to pay you a higher rate of interest on what's left of that debt. And then the other possibility, which we have certainly seen, is what we call bankruptcy for profit. So Friendly's is a typical example of this. Sun Capital buys, one of the funds of Sun Capital buys Friendly's as a portfolio company. And by the way, they were welcomed by the workers there. They don't have a union there, but the workers were very happy. They thought it meant the place would be spruced up. They'd have new items on the menu. There was a great appreciation of private equity coming in. But private equity didn't do any of those things, just loaded Friendly's up with debt, and Friendly's now does become bankrupt. So it goes through bankruptcy. A second unit of Sun Capital lends it money to operate while it is in bankruptcy. It's called debtor in possession funding. So they give them money to operate while they are in bankruptcy. And a third unit, a different private equity fund, also a Sun Capital private equity fund, now buys this portfolio company out of bankruptcy. Actually, no money changes hands on this deal. They buy it by forgiving the money that they had loaned it to keep it operating while it was in bankruptcy. So at the end of the day, Sun Capital still owns Friendly's ice cream, shorn of much of the debt because you go through bankruptcy and the bankruptcy judge decides which debts you have to pay and which ones you can reduce, and mainly without the pension plan. So it was not a unionized company, but it had a pension plan for all of the workers. And they threw the pension plan onto the public agency, the PBGC. which fought back, which said this is ridiculous. When you go through bankruptcy, I mean, the whole thing about going through bankruptcy is that it's extremely rare that you come out on the other side still owning the company. The owners who take it into bankruptcy lose whatever they had in that company. And the PBGC said this is just a scam. They owned it before, they own it now without the pension liabilities, but the PBGC did not prevail. So, yeah.
So, you can't answer this with any precision, but based on your work, if you had to assign weights to each of these factors in terms of their contribution to the profitability of private equity for the general partners, what kind of weights would you give to each of these?
So these are much more prevalent than the first slide. That's the first thing. I mean, there's no question about which is the more prevalent. But the ability to do the OpCo-PropCo depends on your having bought a company that has that kind of property. So that's a model that shows up in some industries. Hertz was taken over by private equity, and they did a OpCo FleetCo. They sold off the fleet of cars and then leased them back. So if you have assets that you can do it with, this is a very popular thing to do, because in a year you've already paid yourself back and probably more. The effect on workers, we have some really, there's not a whole lot of research, but there's some really fine research which clearly shows, I think it's on the next slide, but it clearly shows that there's huge loss of jobs compared to other companies that could have been taken over, similar companies that were not. The taxpayers, that's huge. I mean, that was one of the first things that they recognized, because if you can reduce your tax burden, it has many effects on you. One is it allows you to pay the debt back, right? So that's a help. But the other is it flows right through to the bottom line. And all by itself, with nothing else happening, it increases the enterprise value of the company. So the minute you buy it and load it with debt, the enterprise value goes up. And there's some empirical work that suggests it goes up between 10 and 40% just from that one thing. So they all do that. They load as much debt as they can onto the company. And the debt exchange and bankruptcy, well, the bankruptcy for profit is actually, there are not that many private equity companies that engage in that particular strategy. But the debt exchange, if we're in a situation where they got into trouble because of either the OpCo-PropCo or the dividend recaps, the creditors get to take a haircut. So I guess what I would say is 2 and 3 are probably, 3 is always used, 2 is frequently used, 4 if they get into trouble, 1 if they can. So that would be my answer there. I mean, in retail, the OpCo-PropCo, and in restaurants, the OpCo-PropCo is the most used. Okay, and so this is really the answer to some of the questions that have come up. If they go into, if they are private equity companies that specialize in middle market companies, small and middle market, meaning up to $500 million in enterprise value, and typically, Aidells was about 38 million when they bought it. Batt was about 25 million when they bought it. There are 2 things that happen when you buy a company that small. One is it doesn't have a whole lot of things that you can mortgage. So it's not that they don't want to have 70% debt, but they can only do 40% debt because there's just not that much to mortgage. So they have less debt. And the second thing is, and the second thing, of course, the financial help. One of the things that the consolidation of the banking system has done is you no longer have neighborhood banks big enough to make loans to small and medium-sized businesses. These businesses are desperate for private equity to come in and give them a hand. They appeal to private equity, and so private equity can be very, very selective. And there's one study that showed that private equity invests in about 15% of the mid-sized companies that ask for private equity investment, so they can be very selective, but they can come in and be a help here with the smaller companies. And there's opportunities for operational improvements. You can introduce a modern IT system, a modern accounting system, marketing know-how. There's a lot of things that you can bring to a small or medium-sized company. When you get to the big companies, they already figured this out. They have an enterprise value of $1 billion. They know how to market. They already have an IT system. They have professional management. They have an accounting system. So they don't have many opportunities for the operational improvements or the business strategy improvements. But they have lots of assets that can be mortgaged. And so the strategy there is the high debt strategy, the high use of financial engineering. Don't bother about trust, and as I said, there are few opportunities for operational improvements. And if we look at the net effects of this, so this is a very important study in which they did a matched sample of enterprises, of establishments and then of firms, to see what is the effect on employment. And what they did is they looked at the companies that were targets of private equity, the target companies, and at similar companies on many key metrics that were not taken over by private equity. And what they found looking at the establishments is that before they were taken over by private equity, these companies were growing more rapidly. We have other studies that show that wages were rising more rapidly, wages were higher, employment was growing more rapidly, because they want to sell the company in 3 to 5 years. You're not really going to take over a company that you think is in trouble and think you're going to be able to sell it in 3 to 5 years unless you're doing that little sliver of turnaround investing. So they basically take over the healthier companies. And in a very short period of time, you can see that within 2 years, the target firms had 3.2% lower employment growth relative to the other companies. So if you're in retail employment has gone down. So the question is, how much has retail employment gone down in private equity-owned retail establishments compared to non-private equity-owned retail establishments? And it's fallen 12% more. If you look at publicly traded companies taken private, it's 10% more. So, and over a 5-year period, you can see that the employment is 6.4% lower than it is in comparable publicly traded companies. Well, that's not such a good result if you want to put your work up on the website of the Private Equity Growth Capital Council, where a lot of this work can be found. And so they then took a look at the firm. They could only follow firms for 2 years, because after that, firms disappear. You can follow establishments, but the firm may disappear, may be taken over by another firm, and may have gone bankrupt. The establishment may have been sold off. So they can only follow for 2 years. And even in those 2 years, you can see that the targets have almost 4% lower job growth than the control companies. So what do they then do? Well, they take a look at the firm and they say, well, firms can also acquire companies. So you buy a company and then you buy another company to add on to it. So the question is, if you bought a company and you follow it for a couple of years, what was the effect? That's the continuing effect. Or you can add on a second company. You take the company and its workers. And if you count the workers who are added on, these are not jobs created, and these are not jobs that continue because they're in private equity hands. These are jobs that are added on when you add on another company through a merger or acquisition. And then the difference falls to a little less than 1%. That's the number. That's the number they like to talk about. And however, we are very interested in the establishments because that's where people actually work. And you can see that the news is not good at the establishment level. Because of the OpCo-PropCo, because of the dividend recaps, for all of these reasons, there's much higher rates of bankruptcy in private equity-owned companies than in other companies. Now, if you, the first study that we looked at funds that were launched between 1970 and 2002, so that they could follow those funds for at least 5 years. So the research goes through 2007. And what you see is that the bankruptcy rate is twice as high, but on the other hand, it's 1.2% versus 0.6%. And they could make the argument, well, it's riskier, but it's worth it. Then came the Great Recession, and we saw something very different. The restaurant industry, we just highlighted here, this is the OpCo-PropCo model at work, and as soon as the recession hit, if you're now paying rent as the Friendly's restaurants had to, you can see that there's going to be financial distress. You can see that there's going to be bankruptcy. The Wall Street Journal had an article. This is when Mitt Romney was running for president. They looked at the 77 companies that Bain acquired while Mitt Romney was president. 22 of them went bankrupt. So once you hit the Great Recession, the financial engineering did not work for lots of the companies. Here's just a list. I won't take your time to go through it, but all famous companies that you may have heard of that experienced bankruptcy in the year in which they did. We have way more examples of bankruptcies, but these we thought you might actually know some of these companies. Okay, so the stakeholders are not doing very well, the workers are not doing very well, the creditors are not doing very well. Surely the pension funds and the limited partners that have invested in private equity, they must be doing very well because somebody must be doing very well. It's a little hard to tell. We have no transparency here. So we have no real way of knowing what private equity is doing. Every study that is done of returns to limited partners is by definition biased. Because A, you don't know who's in and who's out. They get the data from some, so CalPERS, for example, gave one group of researchers all of the information about their investments. Well, CalPERS is one of the biggest of the actually in terms of the amount of money that they've invested, CalPERS is the biggest. They have $42 billion invested in private equity. CalSTRS has $22 billion. They're the two biggest here in California. In terms of percentages, Oregon and Washington public pension funds have the highest percentages at 21% and 18% respectively. So you get the list of from CalPERS of all the private equity investments it's made, but you don't know how typical it is. CalPERS has been doing this since 1990. CalPERS is really big. CalPERS probably has some influence. What's that mean for New Hampshire? You know, it's like you can't really tell what you have there. That's one set of problems. The industry claims outsized returns. They do it by using the internal rate of return, which you probably all have heard of, and probably in your finance classes you've learned not to use it. It has a lot of problems as a measure of anything. But the biggest problem is the internal rate of return is an iterative computer process that gets you to an answer and that has built-in assumptions. So the assumption here is the fund lasts for 10 years. It makes an investment in year 2, and it sells it at a huge profit in year 3. But this is really good news. But the internal rate of return calculation assumes that whatever the rate of return you got in year 3, you as a pension fund or another limited partner will be able to reinvest the money that's been distributed back to you at the exact same high rate of return that was gotten in the first 3 years by the private equity fund. It's usually not possible. So you can play this game as long as the fund is still operating. At the end of the day, when it liquidates, then everybody knows how much they actually got. Yeah.
If you don't mind, can I just take you back to talking about the target firms and the establishment firms? And I was just thinking about, we have a person on the board of directors of the Anderson School who is a generous speaker in a lot of events, and she was the CEO of Hot Topic, which was a retail store. When she was CEO, you know, she invested a lot in building the culture and doing the right things. The company grew, very profitable, large market share, and it was taken over as target by private equity. She was forced out and it went to pieces. All of the things that she'd invested in that were, as she attributed to its growth, were undermined by the things that she described.
Right.
So I'm curious if you could talk a little bit about the process by which the target establishments have so little control to resist
Yes.
being the target of,
Right.
and particularly a target of this more predatory rent-seeking private equity investment.
So if they're publicly traded, private equity comes along and pays a premium. So they bought Harrah's Entertainment at $90 a share when they needed money, and nobody, because it was so poorly run, nobody was going to lend them any more money. They had to go into the market. They had to have an IPO, $9 a share. So sometimes nobody will lend you the money after a while, or they do figure it out. But the point is, they just took it over by, I mean, $90 a share was like crazy. And so you own the shares, you say, hey, I'm never gonna see $90 again. So that's one example. The second example is where you are buying a division, a neglected division of a bigger company. So the manager of that division has nothing to say about it, but it is the parent company who sees an opportunity. So Mervyns had been owned by the same company that owned Target and later became Target. They had Target, Mervyns, and Target was so popular that they called their whole company Target. They don't want Mervyns anymore. And in fact, one of the questions is whether this was not a conspiracy from the beginning. So the Target shareholders got a lot of money. The private equity company, the Opco Propco, it got a lot of money. There's a lot of money that was being made. And we know a lot. The reason we know so much about Mervyns is that there was a bankruptcy. One of the main ways we find out what actually happened is in the bankruptcy filings. Also at Mervyns, we were able to identify a couple of managers who had been there through the changeover and interview them. But in any case, that's how it happens. You often have no choice. The other way that it happens, and this is the question that you were asking, that is you have a founding family. And the founding family doesn't, okay, you have the first generation and the second generation, but the third generation doesn't want it anymore. So what do you do with it? Who's going to buy it? It's too small to go public, and who is going to buy it? Private equity shows up. And we have more than one case. I don't think we have it in the book necessarily, but we've seen more than. Any idea what I did?
Did you lose your screen? Just tap the screen.
Okay. Okay. So, but in any case, private equity will come in and offer to buy it from the family. Sometimes this is very successful. The Aidells sausages, the hospital example, but sometimes the family sees what's happening and does everything they can to buy back the brand. And sometimes successful, sometimes not. So. Those are the three ways that they do it. They buy a family one, they take a publicly traded company private, or they buy a neglected division of a bigger company.
Eileen?
Yeah.
So, we know that instances in which there's collusion between the managers of the publicly traded company and the private equity investors, where the managers essentially are bribed in some way with job security or what have you. Yeah. Is that unlawful?
No, they just give them a pay package. And not only is it not unlawful.
But they're not acting in, they may not be acting in the interest
Oh,
of.
I see your point. Yes, yes. So in the Mervyns case, where they actually, it's very hard to prove. But in the Mervyns case, in fact, it never went to court, so we couldn't get all the final documents. But that was the claim. That was the claim, that it was a conspiracy from the beginning to enrich some people, that they took the dividend recaps when the company was essentially insolvent. That is illegal for the shareholders to enrich themselves when a company, if doing so, will make the company insolvent. So on those two grounds, the workers had no standing. And a lot of the creditors were secured. But the vendors are unsecured creditors. And Levi Strauss was one, and other big enough vendors to fight, and they sued. And the lawyer who represented the vendors got the biggest settlement that anybody has ever gotten in a case like that, because it turned out that what they did was illegal. And it cost the Sun Capital and their partners $400 million. Which was about a third of what they had made in the deal. So, they don't want to pay out $400 million every time they turned around, but it was the cost of doing business. So yes, it is, yes, some of this behavior, if you can demonstrate that it was done intentionally and that they knew that it was going to make the company insolvent, that they overpaid at the beginning, that they took the back. Any way that we can get the screw back?
It's the
Back there, it's just dead for me? Okay, okay then.
So you just have to look,
Slap it.
just go back one.
Okay, so the internal rate of return is not a very good measure for technical reasons. It's also not a good measure because it's easily manipulated. Now that you know that things that you do early in the life of the fund will have a big effect on the size of the internal rate of return, that's one of the motivations for these dividend recaps. You take a dividend recap, you give the money out to the limited partners, and that will boost the internal rate of return, at least until the time that the fund is liquidated, when that's all they got, you know. So it's really a flawed measure, and also it doesn't take into account the fact that you might have done something else with the money. And so academic research looks at something called the public market equivalent. And the public market equivalent essentially compares over the life of the fund, typically 10 years. What do you get from having been invested in that fund for 10 years? And what would you get if you had made the similar investments timed in a similar way into the market, into a usually a S&P 500 index fund? And the original research along these lines was done by a guy named Steve Kaplan and a woman named Annette Shore. And really, they developed a brilliant way of doing this. It's really it's like the gold standard for how you do this kind of thing. And their first study, which came out in 2005, looked at funds that were fully liquidated. So in fact, you actually know what did the limited partners get back. There's no fooling around with this. And what they found is that on average, you would lose money by investing in a private equity fund. On average, they made 93 to 97 cents for 9% of what you would get by putting in a stock market index with no risk whatsoever, and completely liquid. Here it's illiquid, you put your money in for 10 years and they engage in risky behavior. That was the average. What they discovered is that the average was driven by the top quartile funds. We do have in any year about a quarter of the funds that beat the market sufficiently to have made it really worthwhile to have invested in that fund. The other 3/4 don't do so well. And in that 2005 study, from the 75th percentile down, you were losing money. And at the 25th percentile, you were really way behind the lowest quartile of funds. So that was the gold standard and that was the method, but this didn't really sit too well when Romney was running for president. And we had three good academic studies. That is, if you are able to read the tables and you are able to follow what they did, you will find out what really happened. But they spin their results. It was unbelievable to me. People in top universities who present their results in a way that you would never know what really happened unless you really read the article. What all of these studies have shown, basically, is that the top quartile funds do outperform the market, raise the average, but the median fund, if you compare it to the S&P 500, just beats the market by about 1% a year. This is not enough to compensate you. There's no risk premium here, no liquidity premium. What the limited partners say is they want to beat the market by between 3 and 4% a year, otherwise it wasn't worth doing. And at the median, they're beating it just at 1, and that's compared to the S&P 500. Below the median, obviously, they're doing much worse. If you compare, so private equity is not big enough to buy the S&P 500. If you compare them to the Russell 3000, which has companies in it the size that private equity firms can actually buy the companies, they do much worse. They just about match the market at the median. So the limited partners I think are in for a surprise. It's a highly cyclical industry. If you come into a fund in the middle of a recession when people are kind of leery about getting into these funds and ride it up, if you came in 1998 and they sold the companies that they bought in 2005 and 2006, that fund probably did pretty well. If you bought a house in 1998 and sold it in 2005 or 2006, you probably did pretty well. But they have right now. They have more investment in private equity funds now than they had at the peak of the market before. This is the highest amount that they have. We're at the top of the market. As you know, firms are very expensive to buy. They can't find targets that are cheap. It's not clear. The funds that are launched at the top of a market generally do much worse. So some pension funds will do okay, but many are going to be in big trouble when these funds finally liquidate. You see what they really got. So on unions, where they come in and save a distressed company, the steel industry, I don't have time to tell the story, but the steel industry, Spirit, which they did turn around. We would not have an integrated steel industry in this country today if it were not for private equity. Spirit Aerospace, which was a healthy company, spun off from Boeing, which hated its workers, as you all know. So maybe you don't know, but anyway, there's bad blood between Boeing and its machinists and its engineering workforce. So they were happy to sell off Spirit Aerospace, which was bought by a Canadian private equity fund, which had a whole different view of how it should relate to the unions, and that was successful. Dana is an auto supply company, and this was another successful case of private equity coming in, working with the union, and saving a distressed company. The negative cases where they come in and they close factories and they lay off workers. So we have kind of a comparison. Spirit Aerospace and Hooker Beechcraft are both in aerospace. Dana and Delphi are both in auto parts, and you can see that when they come in with a very negative attitude towards the union, they're not interested in working with the union, they're not thinking about how to motivate and bring in all of the things that we know make a company successful, they don't succeed. And we also have the cases where they try to dump the pension fund. And Scott Brass is our favorite private equity company, Sun Capital, again, that wanted to get out of its pension fund liabilities. And then we have a case, it was Texas Energy, TXU in Texas, now called Energy Futures Holdings. Company, this is KKR actually, who you might not think was going to do this, but whichever general partners were in charge, they came in. We heard from the IBEW that they had a great relationship with the union. They talked to them in advance. They worked together to figure out what to do. They met with all of the environmentalists in the area. They tried to be environmentally respectful and do things in the best possible way. They worked closely with the union. But the model is the model. The model is load the company up with debt and hope for the best. So they loaded the company up with debt. To pay back the debt, they had predicted that natural gas prices would rise. Along comes the Marcellus Shale, and natural gas prices have plummeted. So for all their good intentions with the union, with the environmentalists, with all the meetings that they held, with taking everybody's point of view into account, doing everything you might want a private equity company to do, they still loaded it up with debt. And if their calculation was wrong, there's no margin for error. There's no ability to change what you're doing because you just don't have it. And they've been teetering on the border of bankruptcy for a very long time, and probably will go bankrupt within the next week or two. So they're really on the verge. They're just working it out they're trying to prearrange the bankruptcy with their creditors before they do it. Okay, so for those of you who are going into management, HR, IR, we put out here a few questions, which I'm running out of time. I'll just go through them quickly, but if you want to talk about them in the discussion, that's fine. As Rose pointed out, the capital structure, especially high debt, drives strategy, and it shrinks the degrees of freedom for strategic management in HR. The wealth extraction comes from many things. It's not just the labor process, right? It's not just what are you paying workers, but it comes from many places. And the unit of analysis has to move beyond the workplace and take into account the other ways that private equity makes money. And then for the future, we'd like to understand better how private equity uses these mechanisms in different industries. I think that was Sandy's question. I mean, which do you see where? You don't see them all in all places. To what extent have these strategies diffused more broadly? So to what extent do we see publicly traded companies doing it to themselves in order to get the advantages? And what are the implications for unions, for worker power, and representation and collective action? And then finally, which I'll leave for discussion, the policy recommendations that grow out of this analysis. The limited partners and everybody else need more transparency. We need, you know that Dodd-Frank tried to limit compensation. Those rules never got written, but there was an effort in this country to limit the compensation of the highest paid person to several hundred times the lowest paid person, but just not any old thing you want, and we haven't succeeded. They've done better in Europe on that. And the preferential tax treatment of carried interest, there's no good reason for having it. Reduce the incentives for the use of excessive debt. Maybe we don't have to quite have, I mean, I don't think there are any good economic reasons for why interest on debt should be tax deductible and dividends should not be. So let's revisit that. Maybe we don't have to have it. Maybe not all debt should be tax deductible, maybe up to some proportion of whatever it is. We have seen one effort now to actually limit debt. So the average now, Rose, for the amount of debt to earnings is about 5.3 times.
5.3
Yeah,
times
so
debt
five-
to equity.
Right, so when you go to get a leveraged loan, typically it will be on average 5.3 times EBITDA, earnings before interest, taxes, depreciation, and amortization. The Fed sent a letter to the banks. It's really the softest kind of regulation you can imagine. And it said, if you make a leveraged loan that is 6 times earnings or more, we're going to come ask you why you did it and how you think it's going to be paid back. We will be looking at you. And so the banks have been reluctant to make loans that big, and private equity is screaming bloody murder. So even a simple thing like that can help at least to keep us from the really excessive situations. Reduce incentives for that Opco-Propco company idea, eliminate those dividend payments in the first 2 years. You've just bought the company. You don't know whether it's going to be strong enough to pay dividends or not. Let's not do it too early. And then, of course, laying off workers, it's cost-free to companies. So here's a company, it's better than the other companies. You're buying it because it's better than the other companies. Who made it better? Who built it? And then you come in and you just lay off the workers who were responsible for making it a better company to begin with, and it costs you nothing. If you had to pay severance based on years of experience with the company, I think you would think twice. Does it make sense to lay them off, or is there something I could be doing that would make more sense? The WARN Act, where if you want to close down a factory or a facility that has more than 50 employees, you have to give 60 days notice or pay 60 days wages and benefits. Well, the little portfolio company goes bankrupt and says, well, we'd like to pay it, but we don't have any money. The workers can get in line behind everybody else in bankruptcy court if they get it, okay. And the private equity company says, oh, I'm a financial intermediary. I'm not an employer. Why would I be covered by the WARN Act? And then the same thing with ERISA. We have loopholes that allow the private equity companies to say, we're just financial intermediaries. We don't have anything to do with the fact that these folks are losing their pensions and to get out of the pension liabilities that you have in a Taft-Hartley pension plan, for example. So those would be our ideas for how to rein in the excesses. So, thank you very much. Yeah.
First of all, for the group, you know, if anybody's interested, we actually, right here, we have a master's in financial engineering. So, two quick questions. One is, I wonder if you think in the case of the employment, jobs, if this productivity seeking versus rent seeking is a meaningful distinction?
So one of the things that does happen is that productivity does go up. Yes. So private equity takes over companies where employment was growing faster and wages were higher. In short order, employment is now below where the others are. Wages are now below where the others are. But because they shut facilities and maybe because they've made some investments, whatever the reason, or maybe there's work intensification, or maybe it's more efficient, we know the productivity has gone up. But you can see that also contributes to rising inequality. So the divergence between productivity goes up and wages go down in that situation. But yes, there's certainly some of that.
Second question is more, it seems like there are powerful entrenched interests here who are using it. And they know it. I mean, Iceland didn't know what was coming, right? But it seems like these banks that are lending money, both, why would they lend the money if they see this coming? And second of all, why don't they have more powerful lobbyists in Washington?
Banks don't hold it. The banks, they make the initial, only if things go sour really fast. So, for example.
So it's the same lack of accountability where they resell it.
Yeah, exactly.
Split it
Exactly.
into pieces.
Exactly. You get the fees for doing it. By the way, those transaction fees are charged to the portfolio company. All the fees that are.
So it is Iceland.
It is Iceland, I guess so. Yeah. So they don't hold it. Every so often, so Bear Stearns went bankrupt, well, it still had Hilton Hotels taken over by private equity in their portfolio, and so you, the taxpayer, if the Fed came to own it, you, the taxpayer, owned it. And it's really a disgrace, just to show you how much, these are the regulators, right? This is Timothy Geithner we're talking about, our former Treasury Secretary. So he's at the head of the New York Fed. The New York Fed now owns these debts of Hilton, And the union came to talk to him and said, this is a cyclical situation. The hotel industry will come back as soon as the economy recovers. Just hang on to those bonds and someday you'll get paid. But no, they let Blackstone buy it at 50 cents on the dollar. So they sold that debt back to Blackstone in a debt exchange. So that's what taxpayer money works. So it's really hard. It's really hard. I mean, this is why I was so happy to see Janet Yellen become the head of the Fed, because she never had any dealings with Wall Street. They never paid her a penny. So they have no real control over her. Whatever she does out of sincerity.
It's really the taxpayers and the workers. That's what it's very.
Well, Larry Summers would have been, their man.
On one of the early sites, I just did the division of the number of companies, of the number of private equity companies, and the number of companies they're holding. There's an average of 6.5 companies in a portfolio per private equity company. So that suggests, at the same time you said that Apollo has 250, Blackstone has 170. So it sounds like it's a very polarized industry. There must be a lot of really small companies that are saying, wow, this is great, we got to get into this, but are not players.
Right.
And can you talk something about that distribution, and how does that line up with the sort of gainers versus losers? The top quartile, is there any connection there between size and your rate of success?
Right. So we have a whole chapter on this market segmentation story.
Yeah.
And so the private equity firms, the real big ones are the ones you hear about, the Blackstones, KKR, Carlyle, et cetera. And so it's like it's like employment, right? So the numbers of deals are much larger in the small deals. So you have a private equity firm that has maybe a $25 million fund and funds one company at 10 million, or maybe two companies, right? And so that's it. So you have a lot of private equity firms that are very small, but they also represent a minority of the capital invested. And then you have a lot of the bigger funds that have a lot of companies they're investing in. Now, when I said the 170, that's not actually ownership, because they also take minority stakes. So for that figure, I didn't separate that out, right? So Blackstone has some minority stakes and then owns outright other companies, and we don't have the numbers on what that is.
But you're right about the orders of magnitude, because they don't want to have too many partners, because they have to share all this money with the partners, right? So if they have a big fund, they buy big companies, so that they only have to buy 7 or 8 of them.
I see.
You have a small fund, they don't want to put all their eggs in one basket. Sometimes it's Rose said they do, but generally speaking, they try not to, so they buy 6 or 7 little companies. But the other thing that's happening, as Rose just pointed out, is that right this minute, they have what they call a dry powder. They have more money, but they're sitting on so much money.
1.1 trillion.
1.1 trillion that they have to invest, okay? But the good companies know that it's not as easy as it used to be. When private equity came around in the beginning, nobody knew what there was, but now the companies know, and they want a good price for it. So they want to buy us, pay us. So if it's a good company, it's probably highly priced. That will make it very difficult to exit at a profit. So they have all this money they have to spend. And by the way, if they don't spend it in the first 5 or 6 years of the fund, they have to give it back plus the management fees. So they have a huge incentive to get that money spent in the first 5 or 6 years. So they've got this 1.1 trillion. They only have a few years to spend it. And typically, they, in the past, would just take over companies, and that's really what we studied. But now they do, they take growth. So you see a company that looks like it's going to go public, but it needs a little bit of money, and you give them the money, and then you make the money when they go public. They do a lot of what they call private investment in public pipes.
Yeah, enterprises.
Public enterprises. So they buy stock on the stock market.
Yeah, so I mean, one of the things that happens is that they become more kind of diversified asset management companies. And so they have a lot of ways of making money. We're focused on this kind of leverage buyout model because it's where most of the action has been taking place. and where you can really see the impact on the company. So that's the focus of what we're doing. But they are, you know, investing, they're getting Southern wealth funds to invest in them now. I mean, so there's a kind of blurring of the boundaries across these, you know, the hedge funds, private equity, sovereign wealth funds, and so they're getting, and some of the big ones like Blackstone have gone public, and then they're getting money, you know, from their own stock and dividends themselves. So, by the way, just I didn't mention this to give a sense of how lucrative this is. Just last week it came out, the 9 top private equity executives earned $2.7 billion last year, which is about $300 million each. And Jamie Dimon, by comparison, does anyone want to take a guess what he made? 34. So, private equity, iBanking, right? So, you know, the top of his game is 34 million. What is it? Blank Find at Goldman Sachs made 70 million, but that's still a third of the private equity guys. So they're really at the top. They're certainly really raking it in, and at the bottom, you know, these private firms, yes, they're not making as much, but they're doing certainly well. Yeah.
That's what they told us. We're rich enough. A little bit.